Last week, I explained a bunch of financial jargon that you probably had heard of before but had no idea what it meant. This week, we're going to go even deeper. Now that you know what a TFSA is and an RRSP, you're probably wondering, okay, so what now? Which account is better for me? What are the exact differences and how do I decide which account to open first? Well, wonder no more, because in this video, I'm going to go through it all. By the end of this video, you'll know exactly which account will fit your needs. Hello everyone, and welcome to the Ready Set Life YouTube channel. My name is Brittany, and I am a millennial financial coach who makes videos all about taking the fear out of finance. Don't forget to subscribe if you haven't already, and make sure you hit that like button if you enjoy this video. I am always looking for feedback, so don't be afraid to let me know what you think. Now that you know exactly what a TFSA and RRSP stand for, if you don't, it means you've missed my last video, so feel free to click the card up above to watch that one first. You're probably wondering how to build these accounts into your own money strategy. It can be a little confusing to make that choice. These accounts are pretty similar in the sense that they both have some sort of tax benefits, but they're very different in the ways that this actually happens. Personally, I've actually chosen to set up both a TFSA and an RRSP. I actually have two TFSAs, but that's a fun little mistake that we'll get into later in the video. Sometimes even financial coaches need help getting their financial together. All right, enough teasers, let's just jump right in. The main difference between a TFSA and an RRSP comes down to taxes. With a TFSA, the money that you put into it has already been taxed. Therefore, when you take it out, it's not taxed. The additional money that you accumulate through growing the account is also not taxed. Each year, when you fill out your income tax forms, you report on how much money is actually put into this account. But all the government really does with this number is track how much you put in to make sure that you're not going over your contribution limits. Remember, you're only allowed to contribute a certain amount per year. With a TFSA, your income tax is calculated the same regardless of if you contributed to this account or not. With an RRSP, the money that you put into this account is not taxed. When you report your income tax, you also report how much you contributed to your RRSPs. And there's a limit to this as well. It's either 18% of your income or up to $26,230, whichever comes first. The government keeps this in mind when calculating your income tax return. So you're essentially telling the government, treat it like I've made less money this year. It's called lowering your taxable income. For example, say that the government taxes 20% for all people making $50,000 and under, but taxes 30% once you cross that $50,000 threshold. If you have a $55,000 salary, it means that you'll be taxed at that 30%. However, if you choose to contribute $5,000 of it to your RRSP, you could lower your taxable income and go back down to that lower tax bracket of 20%. Make sense? Another major difference is that the RRSP can only be used for retirement savings, whereas the TFSA can be used for saving anything. You can only touch your RRSP savings when you reach retirement age, versus the TFSA you can withdraw at any time. Of course, there are technically ways that you can withdraw from your RRSP. For example, there is a special credit that allows first-time homebuyers to withdraw up to $25,000 for their down payment, and there's also a lifelong learning benefit where you can take out a certain amount for continuing education. Other than these special considerations, taking money from this account before you retire causes some hefty penalties. It's totally not worth it. So, why save in the locked-in RRSP if the TFSA is an open book? As I said in my last video, the TFSA seems like a magic account. As long as you stay within your contribution limits, you can put whatever you want in it, do whatever you want with it, and take it out pretty much whenever you want. It's an amazing way to build wealth tax-free. But remember what I just said, as long as you stay within your contribution limits. Each year, you're only allowed to contribute up to a certain amount. From the year that the TFSA became law in 2009 to 2012, the limit was $5,500. In 2012, it went down to $5,000, and then in 2013 to 2018, it went back up again to $5,500. In 2019, the limit has actually increased again to $6,000. On top of this, the contribution limits carry over. So if you were 18 in 2009 and have never contributed anything, your contribution limit is a little over $60,000. There are lots of calculators to find out what your limits are, but the CRA My Account will have your personal, official contribution limits for both accounts listed on your profile. And I'll leave that link down below. So let's assume that you're suddenly rich or that you were super diligent at contributing to your TFSA right when you turned 18. $6,000 a year is not a whole lot, especially if you're trying to save more than 20% of your income. That's the most widely accepted savings rate to strive for. I'll link my video on the 50-30-20 rule up in the cards. Once you max out your TFSA, you sort of have to turn to the RRSP. On top of that, contributing only to a TFSA does nothing for your taxable income. You're going to be taxed at the full amount and potentially high rate that your salary is at. That's totally the advantage of the RRSP. Lowering your taxable income could save you tons of money, depending on which tax bracket you're in. On top of that, it's super important to start saving as early as possible for retirement. Yep, the more money you put in earlier in your retirement funds, the less you have to put in later. And that's not just saying you don't have to make up the time later. It's legitimately the more money you put in now, the less money it takes in general to actually reach your retirement goals. Seriously, I'm gonna link a few retirement calculators down in the description. Just put in some numbers. You'll be floored by how much less you need to save by starting early. That's compound interest for you. If you make a larger wage, it might even be better for you to contribute to your RRSP. Putting money towards your RRSP is paying you. If you keep yourself at a higher tax bracket, you're kind of paying the government. And I'm all about funding social services, but wouldn't you rather keep your money for yourself? Or have the choice to donate it to whatever cause that you wanted to? There's also a third option to consider. You know that hilarious taco commercial where they're trying to decide whether they want hard tacos or soft shell tacos? And that little girl just says, why not both? If you're too young for that reference, wow, I feel old. But basically that's where this meme comes from. That's how I feel about TFSAs and RRSPs. I have both a TFSA and an RRSP. My RRSP obviously is for retirement savings. I'm pretty young. I won't retire for a long time, which means my risk tolerance for investing that money is pretty high. I've got lots of time to make up the difference if something goes south. However, in my TFSA, I'm saving for a house. And I'd like to get a house between the next 5 or maybe 7 years, which means my risk tolerance for those investments is lower, because I'll be needing the money much sooner. If I experience a great loss with that, then I'll have less time to actually make up the difference. Because of these two different goals, I keep my money in separate accounts. Now the caveat to this is, yes, you can have multiple accounts for different things. I could have just chosen 2 TFSAs and invested in them differently, but I didn't choose to do this. Number 1, because I didn't really understand how these accounts worked when I opened them. But number 2, now that I actually have educated myself, I do actually like the idea of having 2 different places to put my money with different advantages. I'm a person who likes options and structure. I like having a retirement account that I can't really be tempted to take money from, and one that I can take from whenever I want for whatever I need. Now, as I mentioned at the beginning of this video, I actually have 2 TFSA accounts. This is still true, and it happened again because when I set up these accounts, I had no idea what I was doing. I was thinking more about savings goals versus what the accounts actually did. I just knew that the TFSA was this magical and good account to have. So I opened 2 up at Tangerine Bank, one labeled car and the other labeled house. Little did I know that you can actually open these accounts and have them just sit there and do nothing. I thought that I was opening an investment account. To me, TFSA was scary. TFSA meant investment. I thought, okay, I should get on this, compound interest and all that, so I opened the accounts. But the funny thing was, when I looked at my Mint.com account summary, I used that to track my net worth, more on that in a future video, the accounts were categorized under the regular account spot and not the investment spot. And that's how I figured out that you actually have to invest those accounts if you actually want them invested. Doi. Now I have one of those TFSAs moved to Wealthsimple, and it's invested and doing quite well. And during that time is when I actually opened my RRSP as well, and that's also invested. Although I've stated before, it's at a different risk rate than my TFSA. That other account I opened is still kind of sitting there basically doing nothing. It's just kind of a regular savings account. And yes, I need to change this. It's kind of silly to have an account like this just collecting measly bank interest, but I'll get to it eventually. Just being honest, I also procrastinate on a lot of things. So, how are you going to choose what account is best for you? Let's do a quick summary of the benefits. TFSAs are great for tax rebates. If you're at a high income, then this would be a really great option to hop on to lower your tax bracket. RRSPs collect tax when the money comes out of the account, not when it goes in. If you know you're going to have a lower income after you retire, then this means that you're going to be paying less to the government later on. TFSAs are taxed when the money goes into the account. If you're not really worried about being taxed too much, but you have some extra money sitting around that you want to grow, this could be a great option. TFSAs can be used for anything. If you want to use it to save for a house, go for it. You want to use it to save for starting a new career, go for it. If you even want to save it for retirement without opening an RRSP, go for it. There are no rules on how long this money needs to stay inside the TFSA. The only limits are the actual amount that you can put into the TFSA. Also, I'm not sure if I mentioned, but you actually never lose this contribution room either. So even if you take money out of your account, you still get that contribution room back in the following year. This makes it a super flexible account. All in all, both accounts are really great, but for different reasons. If you're just starting out, maybe start with the super flexible TFSA and just see how you like it. You can always use that money for retirement if you want to later on anyway. Hopefully that clears a little bit up for you, and let me know in the comments, do you think you'll be opening a TFSA or an RRSP or both like I did? Give this video a like if you liked it, and don't forget to subscribe to this channel for more videos every Thursday. In the meantime, you can check out one of these videos that I've posted over on the sides, and until next time, I'm wishing you great financial health. Bye!